Hey everyone, you're listening to the Ask BP podcast, and today we're going to talk about what's really happening with your mortgage payments. Stay tuned.
You're listening to another BiggerPockets Ask BP podcast, where you'll hear short, direct answers to your biggest real estate questions. Submit your question today on Facebook, Twitter, or the BiggerPockets forums by using hashtag AskBP. And don't forget to pick up your copy of the Ultimate Beginner's Guide to Real Estate Investing and other great content when you sign up for your free account at BiggerPockets.com. With that, let's get to the show.
Hey guys, this is Scott here with the Ask BP podcast, and today's question comes from Walker from Texas, a good buddy of mine, and he asks, what's really going on with my mortgage payments? Walker, this is a great question. I think that it is a question that is very applicable to millions and millions of American homeowners out there who have mortgages, who have homes, but don't really understand the math that's going on behind this and how the details of the mortgage payment really impact their wealth over the long term. All right, so with a typical mortgage, there are four main components, which a lot of us are familiar with. Those are principal, interest, taxes, and insurance. Together, that's PITI, or if you're a finance nerd, you'll refer to that as PITI. The PITI comprises all four of those components within your mortgage payment, and we're going to discuss how each of those components changes over time and how that's going to impact your mortgage payment, and how that's going to impact your wealth building process through real estate. So the first two of that PITI are principal and interest. That's the one that's kind of the most easy to grasp. It's the most intuitive. Principal is the amount of the loan you're paying down each month, and interest is the profit to the bank. So if I've got a $100,000 loan and I'm paying $500 a month on that payment, part of that payment at first, probably let's call it $375, will go towards interest, which is the bank's profit, and the remainder, maybe $125, will go towards paying down the loan, the principal. Now, it's important to understand what's going on behind this. And what the process of the paying down of the mortgage can be shown in an amortization table. This table is interest heavy first and principal heavy on the back end. What that means is more of your payment is going to be interest than principal at the beginning of your loan pay down, and more of your payment is going to be principal than interest at the end. Why is this important? Well, think about this from the bank's perspective. The bank is selling you a product. They're looking to make a profit, right? So in that first year, they want to collect more interest than principal. In fact, if you take my example of a $500 a month mortgage payment, and $375 of which is going to interest, you'll see that over the course of the year, that's about $4,500 in interest the bank's collecting. Instead of a 3.5% interest rate, perhaps, that might be really effectively a 4% interest rate for the bank. So the amortization table has really helped to allow the bank to capture a lot of their profit up front, but still get paid back on the back end. And that's important to understand for us as real estate investors or homeowners, because that helps us understand, hey, the longer that we pay down this mortgage for, the more of our payment is going to building our wealth and the less that's going to the bank. If you're really interested in learning a lot more about the amortization table, which is a pretty complex mathematical equation, you can definitely go ahead and Google that, and you'll see lots of examples of amortization tables, or you can just call up your lender and see your own if you have a mortgage. They're always readily available, and you can see exactly how much wealth you're creating versus how much interest you're paying with your monthly payments. So the amortization table really exists to help the banks make money, right? But there's another part of the mortgage which is also very important to the banks. And that's, this all falls under the umbrella of helping the banks avoid losing money. So, for example, when you put down $20,000 to buy a $100,000 home, that's your down payment. That's helping the bank avoid risk with their loan. If you can't pay the bank back, they can take your $100,000 property, sell it, and recapture all of the value in their loan. In fact, even if the market crashed 20% and the property is only worth $80,000, hey, the bank can go ahead and sell your property for $80,000, and they're just as happy. They've gotten all of their money back. So seeing as one of the bank's first priorities when they lend you money is not losing their principal, not losing the money that they're owed, that's where taxes and insurance really come into play, and that's why they're part of your mortgage payment. So the taxes, if you don't pay your taxes, the government will come and foreclose on your property. The government and the county is senior to the bank in terms of collecting money against the property. And the bank wants to make absolutely sure that you're paying your taxes so that the government doesn't come and close on the house, which is what is protecting their loan. The bank wants to make so sure of this that they actually say, no, you're not going to pay the taxes. You're going to pay us, the bank, and we, the bank, are then going to pay that money to the government so we can be absolutely sure that your taxes are getting paid. That's called, and that money is held in an escrow account. So rather than paying, my property taxes are around $1,200 a year, let's say, for one of my properties. That would come out to be about $100 a month on average. So the bank will actually just say, hey, your mortgage, we're going to collect $100 on top of the principal and interest. And that's going to go into this fund, this escrow account, and we're just going to hang on to it. And when the taxes come due, we're going to make sure we have enough money in there to pay those taxes. Insurance works the same way. The bank wants to make absolutely sure that your property is insured so that if something bad happens, they can, and the property burns down or something, the bank can still collect all the money they're owed on their loan. So you have to go out and find insurance that meets your needs, but the bank is 100% going to mandate that you have insurance, and they're going to do the same thing they're doing with taxes. They're going to say, you're going to pay us on a monthly basis all of the property insurance, the payments for the property insurance, and then once a year, we're going to go ahead and pay the insurance company that so that we're absolutely sure that there's a property insurance policy out there protecting your house. The last part of the mortgage that I want to talk about is a component that is applicable for millions of Americans, but not part of that kind of typical PITI, and it's called FHA mortgage insurance. If you're one of the millions of Americans who put down less than 20%, say 3.5% or 5% on your property, you put down a lot less money, right? So the bank is at risk if you stop paying on your loan. Let's say I bought a $100,000 house and I only put down $3,500. Well, if the market goes down by 10%, that house is only worth $90,000 and the bank's money is at risk, right? If they were to foreclose on the house, they'd only sell it for $90,000 and they'd lose $7,500. So to protect the banks and to encourage people to buy houses, the government allows you to put down 3.5% and then buy insurance for them on your loan. That insurance is usually about 1% of the purchase price of the house, give or take, plus an upfront payment. So if you've got a mortgage payment, the bank will also insist that you pay federal mortgage insurance if you have one of these, lower down payment loans. So that can be a fifth component of a lot of loans out there. All right, so in summary, we've talked about principal, interest, taxes, and insurance. Well, I hope that helped. We've now talked about the four major components of a mortgage and why you pay them with your mortgage payment and how they change over time. All right, so today's quote of the day comes from Mr. Warren Buffett. We've quoted him before, but this one is a really good one. And he says, "Time is the friend of the wonderful business, the enemy of the mediocre." I think that quote is very relevant to today's discussion on the principles of mortgage finance because, like he says, time is going to be your friend if you're paying down those loans over time. But every year, you're going to pay down more principal and less interest and build more wealth for yourself. It's a great thing about real estate. It's a great thing about financing your properties and being in it for the long term and playing the game correctly over the long term. That's it for today. I hope you enjoyed today's show, and if you did, please give me a thumbs up if you're watching me here on YouTube, or put a comment in that section there on the BiggerPockets website if you're watching it there. We definitely appreciate you listening in. Remember, in pursuit of your dreams, don't just learn, but take action. For the Ask BP podcast, this is Scott Trench, signing off.
You've just heard another episode of the BiggerPockets Ask BP podcast. Submit your question today on Facebook, Twitter, or the BiggerPockets forum by using hashtag AskBP. And for more incredible real estate investing tools and education, including a free download of our book, The Ultimate Beginner's Guide to Real Estate Investing, head over to BiggerPockets.com and sign up for your free account today. We'll see you on the next show.